Hello everyone, Manny Gomes here. Just wanted to put together a quick video to offer a little insight and perspective on the market. And what you will see in front of you is a 2-year view of the Fannie Mae coupon, which trades every day in the open market and sets the tone for where interest rates are. If you look closely, this past Friday, we have breached levels that we have not breached in over a 2-year period, and pricing is at the lowest level it's been in over 2 years. This has created about 4.5% mortgage rate, and tomorrow it could probably be as high as 4.625 or so. Now, what happens from this point? We've seen a massive amount of price destruction. In normal times, these price points will be attractive enough for buyers to come out of the woodworks and propel prices upwards. But we're not in normal times right now. We have traders who are scared that the Fed is going to just stop buying mortgage bonds like tomorrow, and they're pricing in what the value of these bonds will be after the Fed has stopped buying these mortgage-backed securities. Now, the Fed is in fact not going to end the purchase program at all. What they're going to do is phase out and decrease the amount of purchases per month. And according to what Ben Bernanke said last week, that could be as early as later on this year, and then eliminate the purchase program towards the second half of next year. But what they're going to continue to do is reinvest the principal payments they receive each month from owning these bonds into the purchase and acquisition of new mortgage bonds. So they're holding on to about $3 trillion worth of mortgage-backed securities, and they will add probably another $500 billion to a full $1 trillion worth by the time they're done with this purchase program. The fact that they're reinvesting that much principal investment into the acquisition of new treasuries and mortgage-backed securities is going to keep rates low for a long period of time. And we will see this major correction here evaporate. Pricing will rebound upwards. It's just a matter of how long it'll take. And if you look at history here, the last couple of summers, we have seen bonds rally into the summer months. And I think that's going to happen again. We saw right here, April up until about May, June, we saw a little bit of a rally. And then again, sometime at some point this year, same thing, July, we saw a nice little rally in mortgage-backed securities. I believe this will happen again, but what we have to do is really carefully guide our clients and make them realize that this move in higher in rates is just unsustainable, and rates will start coming back down. Because if you took out a client 3 months ago and they had a 3 3/4 or 3.5 mortgage rate set in their minds, and they're running their payments off that mortgage rate, their payments has to be much higher. And that may influence their decision to buy the home, or it may influence what type of home they're going to buy for at what dollar amount. And with inventory levels being so tight out there, our job is hard enough right now that we don't need these higher rates to make our job any more difficult. So the only way to kind of combat this is to really be a student of the market. First of all, know what's going on, know what the trigger points are, and then understand how to educate our clients to make the right decision. Basically, our clients, whoever needs to buy a house in the next 12 months, down the road is very likely that rates will be higher. They may be back at these levels, or they'll probably be a little higher, but because this is right now what's priced into the market is the Fed's buying 0 mortgage bonds per month. That's what's being priced into the market right now, and that's not what the reality is. The reality is they're still buying mortgage-backed securities. They're going to continue doing it for at least another year, and then they're going to still, even after that year period is over and they end their initial bond buying program, they're going to continue to reinvest their principal payments into the acquisition of new bonds. So that's going to help to keep rates low for the distant future. And this market overreaction here, it should be used as a scare tactic with our clients. Unfortunately, we have to do that because, regular consumers, they won't listen to us until they see a move like this occur, and then at that point they may take our advice. They have to be scared into taking our advice at some point. We've been telling clients forever, all these low rates, housing pricing is at the rock bottom, take advantage, and we still have fence sitters out there. It just makes no sense. And what this should do is get these fence sitters off the fence. And if we counsel them the right way, we could get them on the side of buying a home versus not buying a home. We just, we have to tell them that rates will come back down. It probably will be slowly, and it may take a couple months or so, but rates will gradually decrease. Now, are they going to come down to 3.5% again? That, I don't know. We have rioting going on in Brazil right now. Millions of people are joining in the riots. We have a major slowdown occurring in China. We have Japan effectively trying to outsource their deflation. And then we have inflation in our own country at very low levels, which the Feds do not want. They actually, at the last meeting, this past Wednesday, they revised their forecast for inflation, and they decreased it by an entire 0.5 percentage point, which is just huge. As deflation or disinflation persists in this country, the value of these bonds increase, because the number one enemy of owning a bond is inflation. You've probably heard it from your financial advisor or on any financial news network. If a bond is paying out 1% and inflation rates are at 2%, the real value of that bond is negative 1%, and which is nothing. But right now we're at around 1% inflation in this country, and that number's come down from last year, and we're in danger of possibly being in a deflationary environment because the cost of oil has remained steady. It's coming down. The price of electronics has come down. The measures that Japan has implemented in devaluing their currency is making all the goods and services from Japan much cheaper for the entire world, and the only way to compete with their pricing is to decrease the pricing everywhere else. So that's going to make it more difficult for companies to increase the prices on the goods and services that they provide, and they may actually have to decrease those prices. So as the prices of goods and services decrease, that's what creates the deflation. And as inflation is very dangerous, deflation is even more dangerous, because Japan has been in a period of deflation for 2 decades, and they're trying very hard right now to get out of it. And the rest of the world is going to probably suffer a little bit because of that. But if those things line up, rioting in Brazil, slowdown in China, European problems still persistent, and on top of that, the fact that Japan's effectively trying to outsource their deflation to the rest of the world, we will see this bond erosion, this price erosion, just really come right back up to these levels, and that may create a lower level of rates for the foreseeable future. But we just don't know that that's going to happen. That's we're in the middle of a road right now, where rates to go to the right or to the left. To the right means they're going to continue to increase or remain at these current levels for quite a while. To the left, they're going to come back down and possibly reach all-time lows in rates, and that's the road we're traveling right now. And that fear factor should be enough to really get any consumer off the fence to purchase a home as rates decrease. Key word there is as rates decrease. If we guide our clients the right way, anyone you approach at open house, if you maintain their contact information and stay on top of them with whatever campaign you want to implement, they will listen to you. If you tell them rates are going to come back down and that actually occurs, they will listen to you and they will buy a house with you. It's just a matter of understanding the markets the right way and understanding how to convey that information. Now, I truly believe that we probably will see rates increase a little bit more before they do start coming back down, but every bit of information is pointing to slightly lower rates in the future. 4% to 4.25% should be the sweet spot for rates. That's about 3/8 lower than the current levels. And once consumers get used to those levels, then we'll be okay. The closer we get at 4% or into the 3s, the more willing someone will be to buy a house, because of the psychological impact of that number. Going closer to 5% is bad. That's a bad psychological level. Getting closer to 4%, that is a good psychological level. So let's hope that we go to the left, rates come back down, this housing recovery we're enjoying does continue, and that things do not go to the right, which means just higher rates and prevalently higher rates. So I'll keep you up to date as things progress, and I'll try to provide you guys with the proper perspective so you can counsel your clients appropriately. I hope you enjoyed this. If you have any questions, give me a call. I can be reached at 203-673-2131.